Hello everybody, welcome back. In this video I want to share with you something that I usually do in private when it comes to portfolio management, because this is the beginning of the earnings season. A lot of companies will report earnings, a lot of things are expected out of the big tech companies when it comes to AI and efficiency and capex, etc. So what should you monitor? What are the metrics you need to monitor to make sure your companies in your portfolio are trending in a nice direction? Because this is not any earnings season. One, this is a very important one because of all the hype we have when it comes to AI. You need big tech companies to deliver. Secondly, the markets are at all-time highs. Markets are expensive, so you don't want to be invested in companies that will disappoint you. So you really want to monitor what these companies are doing. And three, this is the last earnings season that is important for the year. Q3 is maybe the most important one because Q4 it will be too late. Q3, so now we are in October, beginning of November. This is your last chance as a portfolio manager to readjust your portfolio. If you're not sure about a thesis, you have the time to sell your position. If you want to reallocate some funds and to buy specific companies, you can reallocate some funds. You have the time. So this quarter, this Q3 earnings season is, in my opinion, the most important one. And if I make a good choice, good decision or bad decision, it will impact my year-to-date performance. In other words, this is my last chance as a semi-professional portfolio manager to outperform the market or not. And so far, I am outperforming the market. So far, this is my portfolio here. You can check my portfolio that is completely online on eToro, by the way. I'm having like 19% returns year to date, and the S&P 500 is a little bit below this, 16%. So more than 3%. I take it every year. I take it, no problems at all for me. And depending on this earnings season, if my stocks are dropping because they all disappoint, all my outperformance is gone. So you really want to make sure you are very well positioned before this earnings season, right? So yeah, something that I have never shared publicly. I hope you will like it, and I think we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So I want this to continue. So I have to make smart decisions. And in this video, I will give you all the companies I'm monitoring, all the metrics I'm monitoring, so that you can have a sense of, okay, what to expect, what are the KPIs that are important, what are the metrics that I will monitor. Maybe I will make other videos about companies, but I am monitoring so many companies at the same time, I can't make a video about all the companies. Like, I'm monitoring dozens of companies in the US and abroad. So we can start. Obviously, I made a video recently about MSCI. So this is a company I have in my portfolio, and this is a company that I want to buy more as it drops. If they deliver bad earnings, if they disappoint investors for some reason, I will buy heavily. So this is what I started the video with. Your decision, whether you buy the dip or not, or whether you sell or you reallocate, will impact your performance as a portfolio manager. So you want to make smart decisions and minimize the number of mistakes. And I believe MSCI is a company that allows investors to minimize their mistakes. It's a company that has such a high quality that you can't be wrong when you invest in MSCI. There are a few KPIs I want to monitor for this ones. I will not elaborate because I want to talk about other companies. The renewal rate, the subscription run rate for asset managers, the churn rate, obviously, and the comments on the CEO when it comes to the index part. Okay, so margins, growth, churn rate, buybacks. That's it. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. There is another company that I have in my portfolio and I want to buy much more. It's Fortinet. Fortinet will deliver earnings in a few days. I don't have the exact date. And it's a company I have bought recently because of this huge price drop. And after this huge price drop in summer, I bought the dip at $75 per share. If the stock rebounds because they expect great margins in the future, I will increase my year-to-date performance. Okay, it will look good. But actually, I want Fortinet to disappoint. I want them to disappoint, and I want the stock price to go down. This is really strange, but I want the stock price to go down so I can buy more. I have a long-term thesis for Fortinet that is so strong. I'm a big believer in cybersecurity in the future. This is not the first time I'm buying Fortinet. I know the company really well. I bought the company in 2020, sold it at a triple in 2022. I know the company quite well. I've been following the story for more than 5 years now. So yeah, I really expect that the management disappoints. And there are a few things that the management can say so that the stock goes down. Either you reduce your guidance, either the refresh rate for new hardware is disappointing, either the margins go down for some reason, or something which is quite new in 2025, something that nobody talks about on YouTube or Twitter, is now Fortinet is not relying on Google when it comes to their data centers. They are building their own data centers. So Fortinet is right now increasing their capital expenditures, the capex. And if you increase your capex levels, you reduce your free cash flow. So maybe this is not priced in by Wall Street analysts. Maybe Fortinet will disappoint when it comes to their free cash flow. Maybe, maybe not. But what we know for sure is in this quarter, we will have the results soon, they have done their biggest buyback ever. $1.4 billion of shares have been repurchased. If you want to check the cash balance here, let me check. I'm on Grow Focus right now. Quarterly, the company had $4.5 billion of cash. I'm expecting less cash this quarter. Minimum $1.4 billion less because of buybacks. So I'm 100% sure they have done $1 billion of buybacks. What if they have done more, like $2 billion of buybacks? If this is the case, the per share metric will be improved, the earnings per share will look very good, and the stock will go up. So yeah, this will be very important. The amount of buybacks, margins, per share metrics, but also you want to check this with the capex. This is what I will monitor for Fortinet. I hope the guidance is bad. I mean, so you can have some short-term volatility. And if the stock price drops again, I'm a big buyer, very big buyer. I think Fortinet is one of the best opportunities you can have in this market. There is another company that I think is one of the best opportunities in this market. It's FICO. Fair Isaac, you all know this company. It's the ultimate quality compounder quality. For the past few years, it has been great. And they create the FICO scores that you can have in the US. So to judge if somebody is credit worthy or not, they have a score, a FICO score. If the score is high, you have your loan. If your score is low, you have a terrible loan. And very recently, FICO announced a new business model, meaning they want to not be a royalty business, but a SaaS business. So it's a change in business model. It's a change in pricing policy. And the only thing I will monitor for FICO is the tone and explanation from the management team, because this will be the first quarter ever where the management team will explain this new business strategy. It's a shift in the business strategy. So will it work? How will it work? What are the growth opportunities? What are the efficiency opportunities? What about margins, incremental margins? Do you see some traction? I have so many questions when it comes to this new business model. I made a long video a couple of days ago about Fair Isaac, FICO, and this new business model. If you want to check it on my YouTube channel. Yeah, it will be pretty important. Other things that you want to monitor for FICO obviously is the margins, the buyback program, and the guidance. Now you have a mortgage market that is down and declining, and as the Fed will cut interest rates, as the cost of debt will get cheaper, people will be willing to have cheaper debt to buy new houses. You will have more mortgage originations in the coming years. So people will get more debt. People will need more FICO scores. So there is a strong, extremely strong probability that the whole industry gets a huge tailwind next year. Meaning there is a scenario where Fair Isaac increases their guidance for 2026. And if they do this for next year, the stock will go up massively. Okay, and I don't want this, obviously. I want the stock to be as low as possible so I can buy as much as possible. My buy range for FICO is $1,200, $1,300. So you want the stock price to go down. And they announced this change in business model. The stock went from $1,500 to almost $2,000, went back down. Anything is possible. If they disappoint, the stock will go down 10% in one day. It's like this. I mean, FICO is enjoying a very nice high valuation, PE ratio of 60, forward PE ratio of 40. People say it's fairly valued because of the quality of the business model. I disagree. I mean, to me, it's just too high a price. I need some discipline in my process. And this is exactly the reason why I am generating 25% per year. Because of a very strong discipline when it comes to the price paid. Okay, I'm very much aware that the higher the valuation, the lower your returns if you buy. And the cheaper valuation, the better your returns. I bought Fair Isaac when it was trading at a PE ratio of 25 back in the days in 2022. Nobody was there. I mean, people that are talking about FICO right now, they didn't buy FICO in 2022. Very few of them. I'm checking everybody, and they were not here at the time. They didn't know how scary it was to buy FICO in 2022. So now the stock is up. The business model is fine. The management team is confident. People are bullish, and they say the forward PE ratio of 40 is okay. Yeah, this is a good strategy. I'm not saying this is a bad decision. I'm just saying it's not for me. Okay, this is an extremely well-run business model that has very good chances of outperforming the market. But at some point, you have a price that is too high. Everything is accelerating for this business. Free cash flow accelerating, revenue accelerating, margins accelerating, the buybacks accelerating. So you have very few negative points for FICO. I hope the stock gets demolished in the next few days because of a bad earnings report. And I think I will make a video about this because it's a very important company for my career and my portfolio in the future. So yeah, a very interesting case. I will definitely monitor this one. Another company that is really important, I think I have never shared this publicly on YouTube. It's Amazon. I am a shareholder of Amazon. It's a big part of my portfolio, and I want to sell Amazon. I want to sell Amazon, but not before the stock price rebounds, because Amazon is cheap right now. I think it is cheap. I want to sell Amazon not because I think it's a bad business model, but because I have thought about it a lot, and I only want to buy companies with extremely high margins and a buyback program. And Amazon doesn't have these extremely high margins and a buyback program. So it's just a matter of philosophy, right? Amazon is a great business. You have huge levels of opportunities in the future. And there are a few things I want to check, to monitor when it comes to Amazon. They will report on Thursday, I think, of this week. So yeah, I will monitor this. You want to check the growth in AWS. Obviously, it's very, very important. Maybe the most important thing is the growth in AWS. Can you grow more than 17%? Last quarter, the stock dropped 8% because the growth in AWS was not great. You only grow 17%. And now, because of all the Anthropic data we have, we expect the AWS segment to grow at least 20% per year. What if they increase their guidance and they expect to grow 20-25% per year for this year and next year? It will be great. Number one thing I want to monitor. Second thing, what about CapEx? They are starting a new CapEx cycle, reinvestment cycle. It will decrease their free cash flow. So you can't expect a buyback or a dividend. They will just continue to invest massively in the next leg of innovation. Third thing I want to monitor is maybe some comments from Andy Jassy, the CEO, on robotics. Now they just announced a new plan of having 600,000 robots or something like this, or robots that will replace 1 million people. Anyway, I don't have the exact number. I know Amazon is enjoying more than 1 million robots in their warehouses, similarly to Mercado Libre, etc. This is the ultimate robotics play, in my opinion. If you want to invest in Amazon, if you have watched the movie Terminator or iRobot, well, it ends badly, but at the beginning, robots were great ideas. So Amazon is in a lucky position of being the number one robotics play. If you believe we are entering this age of the Will Smith movie called iRobot. Great movie, by the way. So yeah, you want to check the margins. You want to check the comments from the CEO. Also, last quarter, people didn't like the earnings call because it was not exciting. It's very funny how markets work sometimes, because now we live in the world of AI. You want things to be sexy, to be fast, to be big, to be huge, to be profitable. And when you have a rational CEO, Andy Jassy, that when asked a question about AI, he just tells you a rational answer, people get sleepy. Get bored. Okay. And I've seen a lot of people complain about the lack of passion and enthusiasm when it comes to AI and Andy Jassy. So the tone of the management here for Amazon will be very important during the earnings call. If Andy Jassy, the CEO, announces something big, a new increase in CapEx because of new AI implementation, new deals, Anthropic, AWS, the stock will go up. And if this is getting boring, maybe the stock will go down. And actually, for this company, I want the stock to go up immensely. For Fortinet, I want the stock to go down so I can buy more. For Amazon, I want the stock to go as up as possible because I want to sell the position. So it will be a pain in the neck to have this in a drawdown again. On a year-to-date performance, Amazon is flat. Compared to, my performance is 19%. So it's a drag on my performance, right? You definitely want this to go up so I can sell it and buy more Fortinet. So yeah, hope the best for Amazon. Look at margins. Now you have a valuation that is reasonable. You have a PE ratio of 35, forward PE ratio of 30. I would not look at the price to free cash flow because of all the CapEx investments. So now Amazon has profits. You can look at the PE ratio. If you prefer, you can look at the price to operating cash flow, and this is rather cheap. So I am not a seller at current prices. The best case scenario would be Amazon goes up immensely because of an improvement in AWS and growth rate, etc., enthusiasm, AI, growth rate, blah, blah, blah. And at the same time, Fortinet is decreasing their guidance, being cautious, not sexy at all. That would be a wonderful arbitrage, and I would be very happy to lose money because of Fortinet and earn more money because of Amazon, right? Okay, other companies that are very important in this market. Obviously, you have Google. What a turnaround play, right? What a turnaround play. A few months ago, nobody wanted to touch Google when it was trading at $150. And now at $250, people say Google is the best. Google is the best company when it comes to AI. Google has the best ecosystem. Yeah, exactly what I preach on this YouTube channel and inside my coaching program. Prices drive narratives. It's always the same. And if you are new to this market, to investing in the stock market, you don't know this, but you will learn this the hard way. As always, when the stock is down, people say it's the worst business of all time. When the stock is up, people say it's the best business of all time. Now, Amazon is disappointing. If you look at the 5-year performance, Amazon is underperforming the indices and all the Magnificent Seven. So people say Amazon is bad, Amazon is horrible, Angie Jassy needs to retire, to get fired. Well, people said exactly the same thing for the CEO of Google a couple of months ago, Sundar Pichai. They said the CEO didn't get AI, he didn't understand the threats from AI, and now the stock is up. People are praising the CEO. People are so weak when it comes to having beliefs. In the stock market, people change their mind all the time. People are so weak, so you really want to be careful who you are listening to. When it comes to YouTube, I'm sure you are watching plenty of other channels. I'm following plenty of other channels on YouTube. Also Twitter or LinkedIn or Instagram. Anyway, you want to be cautious when people are changing their mind all the time, when people are emotional, because it is not helpful in this market. If you look at the best investors of the world, they are not emotional. Fun fact, you clicked on this video, not for this, but let me give you a little bit of story. You have a book that was released by William Green called Richer, Wiser, Happier. One of the best books I've read about investing. Please read it. Please give money to William Green. Buy it on Amazon. You will get it tomorrow. And it's a compilation of all the best investors in the world, their lifestyle, quality of life, and the lessons they have to share with the world on how to live your life and also how to outperform the market. And there is a clear segment, a clear, how can I say it? A common attribute to all these big investors, that they are very rational, not emotional at all. And Charlie Munger, the late Charlie Munger, at the time when he was still alive, he read the book, and Monish Pabrai asked him, okay, what do you think about this book, Richer, Wiser, Happier? And Charlie Munger said, yeah, it's very funny how everybody here on this list got divorced. We are big investors. I mean, this is the best investors in the world, right? So they are very rational, and sometimes for relationships, let's say it's not the best to be rational. I know this 99% of my audience is male, so I'm talking to guys here. And yeah, sometimes it's not too good to be very rational, but in investing it works very well, which means I will be divorced in the future. I have a very good chance of being divorced in the future. Time will tell. I don't know if I will be on YouTube 30 years from now, but I'm too young for this. Anyway, so you want to be rational in this market. You want to be not emotional. You want to trust your gut. You want to trust your analysis. And for Google, now the sentiment is very euphoric. People are saying it's great. Google will outperform the market. They have the best ecosystem, so they don't have to disappoint now. Now they don't need to disappoint at all. They must deliver good guidance, good revenue growth, good earnings per share growth, good capex, good guidance, good free cash flow. They must not under-deliver at all, because the expectations are very high. And if you have low results, disappointing results, the stock will get crushed. So hope for them they continue to be slow and steady and continuing to generate more users in Gemini. Now they are going to integrate everything with Gemini, and you have some threats with ChatGPT and Gemini. Anyway, you want more traction for their equivalent of ChatGPT, Gemini. You want more data. You want more efficiency when it comes to AI. You want AI implementation on the whole ecosystem. This is what will make the stock go up in the future. If they increase their guidance for capex, meaning more investments, more data centers, more revenue in the future. And also at the same time, we just learned a couple of days ago that Anthropic is partnering up with Google. So they will buy TPUs, etc. It's not the goal of this video to go in depth about this one, but you have a new big deal that will massively increase the growth rate for Google Cloud. You want the management team to talk about this. If they don't talk about this, it will be bad. But I think it's almost for sure they will have to talk about this, or questions on the earnings call will be about this new deal with Anthropic. Anthropic is a big client from Amazon and AWS, and now they are partnering up with with Google, Alphabet. So I want to check. I own both these companies, so I want to check what is happening here. Is this beneficial for both these companies, or is this a drag for Amazon? So a negative for Amazon and a positive for Google. Okay. Yeah, this is the kind of questions I'm wondering in private, and I've never made a video on YouTube. I don't know if that's a little bit messy for a YouTube video, but I mean, I'm testing now today with this video. Let me know if you like this format of the behind the scenes. What is happening outside of YouTube? What is happening behind the scenes when the camera is not recording? All the questions portfolio managers are asking, all the things you want to cross-read between companies. Yeah, that will be pretty interesting. And also you want to cross-read the information with Meta. Obviously, they just released Meta glasses, so maybe you will have any information about this one. You have more ads on Meta platforms. I don't know for you guys, but I'm a daily user of Instagram, not Facebook. This is not for my age, but for Instagram, and you have more and more ads for Instagram. The ramp up in monetization is continuing and in full force. I see more and more and more ads on Instagram. My guess is they will continue to beat and raise Wall Street estimates because they continue to monetize their channels. And now they started the monetization on WhatsApp. They continue to squeeze all the juice on Facebook, and now they are starting to squeeze all the juice for Instagram. And I don't know how big the advertising part will be, but now for sure I see more ads. Now for sure they continue to monetize all their channels, all their platforms. So you want to see good growth, good monetization. I don't expect anything bad for Meta platforms actually. The last quarter was fabulous. Q2 was fabulous. The stock went up 10% in one day. And I believe since then, the stock is flat, like nothing has happened since. You want this to continue. Now, Meta platforms recently announced a deal to make a new data center play using debt. So you see this, the cash balance that is going down for Meta platforms. I'm expecting the cash balance to continue to shrink, so you will have more debt than cash. Now the new wave of data center build out will be with debt. Oracle already started. Meta platforms is following. Now, right now, as I'm speaking, all the data center projects are being financed by the cash flows of Oracle, Google, Meta platforms. But the pace of innovation is so quick, the demand for data centers is so big that you need to take more debt to have this link between supply and demand. What I want to say is now it will be more risky for the Magnificent Seven players to build more data centers in case of overbuilding. You are not building data centers using your cash. Now you tap into the leverage, the debt. What if you are wrong? What if you have this overbuilding risk like we had in the dot-com bubble or cable companies? Or I mean, you had plenty of examples of this in the industry, in history. So it will become increasingly risky to continue building more data centers in the future. Now it seems like this quarter and the Q4 will be inflection points for all these capex companies, capex intensive companies. So yeah, we will see, but I don't expect good things in the future if they tap into the debt market. Yeah, so these were the big companies I'm following. Actually, I'm following plenty of other companies, but I think that will be enough for this video. Maybe I can make an episode 2 and other videos in the meantime. I hope you've liked this new format. Let me know which companies you're following, and I wish you a nice rest of your day. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.